What are the most common retirement questions out there? Well, here to talk with us about that as part of a continuing series is Dana Anspach from Sensible Money. Dana, welcome.
Hi, Bob. Great to be here.
Great to have you here. We have covered quite a few questions that you get from clients and prospects. We're on to number 5, which is what are my sources of income and what financial assets should I draw on first during retirement?
Yeah, that is a common question we get. I think that's sometimes one of the first things on people's minds. Once they know they're going to retire, it's, well, how's this going to work? We have this collection of stuff that we accumulate as we're saving and investing. And suddenly it's, well, how am I going to access these things? And when should I access them? And should I take this one first or second? Or what should I sell? And so we like to start with a timeline. We first lay out all of the sources of cash flow that are coming from what we think of as non-financial assets. You're going to have Social Security. Most of us have that in common. Some people have pensions. They lived in other countries. So sometimes there's pensions from other countries. Sometimes there's pensions from workplaces that we encounter. So we factor those in. Sometimes people have deferred compensation plans if they're executives at large companies. And so that can be a source of cash flow that is coming from a financial asset, but it has to be paid out over a specified time frame according to the terms of that deferred compensation plan. So there's not a lot of flexibility around it. It's very specific. There's annuities. Sometimes those have some very specific payout options. So first we have to lay out all of those things that have very defined payouts and create a timeline. And then we solve for what needs to come from the other financial assets. And when we think of those, we group things according to tax treatment. There's your non-retirement accounts, there's your, tax-free sources of cash flow such as Roth IRAs or health savings accounts, and then there's your traditional assets, 403b plans, 401ks, IRAs. Every dollar that comes out of those is going to be taxable. Now, when you're talking about drawing out of those various account types, I think there's this common perception that I'm not going to touch my traditional assets until I'm now age 72 and subject to required minimum distributions. I think, you encounter that, I encounter that. And so one of the things we think people ought to take a look at is, does that actually make sense? Sometimes there's a reason to say, well, I should actually be drawing out of my IRA before I turn 72. In the long run, meaning when I look over the life of my retirement plan, that may be more tax efficient than drawing out of other things. I think there was one other thing, Bob, you and I were talking about, which is just the tax treatment of various things. So the other thing we encounter when you get to non-retirement accounts, meaning we might have someone saying, well, I need to take $30,000 a year out of this trust account or joint brokerage account. If there are CDs and bonds maturing, when that bond matures and you take that $30,000 out, that's not taxable. And so just because you took money out of a certain type of account doesn't mean that your cash flow is necessarily aligning with what's showing up on your tax return. And so when we talk about that whole question of what assets should I tap first and second and all of that, those are all factors that someone needs to consider in answering those questions.
Right. So there is a rule of thumb that many institutions and others recommend. Have you any thoughts about that rule of thumb in terms of the order of accounts from which to draw money?
Well, Bob, I don't even know if I know that rule of thumb. Is that the one that says, you should wait until your required minimum distributions?
Right. So that you might take money from your taxable accounts first, and then later your traditional IRAs, and then after that maybe your Roths. But it's
Well, as you know from many of our conversations, I'm not a big fan of blindly following rules of thumb.
yeah.
I think they have their place. That rule of thumb comes from this traditional thought process that you should let your tax deferred assets grow within that tax deferred wrapper as long as possible. But when you actually chart it out in a spreadsheet that accounts for taxes, it is not always the right answer. Now, for clients that have a large source of taxable income that's going to begin, let's say at 60 or 65 from a pension, for example, or for deferred comp plans, in those cases, we find that that traditional way of looking at it usually is the most appropriate answer. So we do typically have them waiting until age 72 to begin their required distributions. But we have many, many people who don't have pensions, they don't have deferred comp plans. And so when we look at their plan, that is often actually the incorrect thing to do. Taking money out earlier from those traditional IRA assets, perhaps through a Roth conversion or even just taking it out to fund consumption, can often lower their required minimum distributions later. And so there's other factors that come into play, such as the IRMA thresholds. IRMA is the income related monthly adjustment amount that applies to your Medicare Part B premiums. And so the higher your modified adjusted gross income, the more you may pay in IRMA premiums. And so it seems backwards, but sometimes taking money out of your retirement accounts early in retirement can actually reduce the overall tax impact that you're going to experience later in retirement once you are age 70 and older. And so that's why we're a fan of not blindly following the rule of thumb, actually charting it out and seeing which course of action puts you in a better financial outcome.
Yeah. So as you're talking, I'm reminded of two buzzwords that commonly are associated with retirement income, one being tax efficiency and the other being tax equilibrium. And it sounds like what you're describing is creating a balance between what's tax efficient, maybe in the current year, but also what creates equilibrium over the client's lifespan.
Yeah, I mean, when you use a reasonable set of assumptions, you can model out what tax rate or marginal rate someone's income is going to fall into. And we've seen cases where people, can go the other direction too and over convert to Roth IRAs. You wouldn't want to do that later in life. Does it really make sense to have zero taxable income? Probably not. You have a certain amount of standard deductions, and the first tier of the tax rate is very low at 10, and in the future maybe at 12%, but still that's a pretty low tax rate. So I wouldn't want to pay taxes today, at 24% if some of that could have been deferred and be taxed at 12% later. And so that's why, you have to look at it on a case by case basis and really see what makes sense, because you can't even use a rule of thumb to determine what's tax efficient for you. That
Right.
might be different than what's tax efficient for the next household.
Yeah. And the cost of making mistakes here, it could be not trivial, right? It could mean you're bumped yourself up into the next highest marginal tax bracket.
Yeah, it can actually add up to, thousands, if not even hundreds of thousands of dollars of tax savings over a 30-year retirement time horizon. So you are correct. It is not necessarily trivial amounts.
Yeah. So we covered a lot of ground. Anything we missed or just bears reemphasizing?
The other thing we probably didn't talk about are people who have rental income. And so, some people enter retirement with rental properties, and that cash flow needs to be factored in. At some point when those properties sell, there can be depreciation recapture, which can, of course, cause extra tax consequences. So just the timing of when you plan those things out can be important. When you start to have more and more complexity, more and more different asset types that you could potentially tap, that's when doing some planning ahead of time can pay off and help you tap them in a more efficient manner.
Yeah. So Dan, it's always a pleasure chatting, having you share your knowledge and wisdom with our viewers. I look forward to our next episode where we talk about whether someone should leave their 401k with their employer or roll it over into an IRA.
Oh, yes, a touchy subject. I look forward to talking about it.